Okay, so we were talking about this story that comes up on the General Mills website about a box of Cheerios sits on the kitchen table, and you think about this, and you talk about the growth rate. How do you grow in the food business? You got to do a couple things, right? You've got to get more people to eat your food, or you have to get people to trade out what they're eating now for the products you're producing. So if General Mills is on every kitchen table already, and people are already eating that food, there there's not a lot of growth potential there. Uh, People are not switching to your product because they're already there. So where's the growth potential? They've already got that sale locked up in their free cash flow number. So there's not a lot of growth there. And any new cereals that they put out there, new products, can really cannibalize the other products they make. People can only eat so much in a day. So there's not a lot of growth potential for the company when it comes to people buying their products and switching from another product or eating more because we can only eat so much. And people are pretty loyal to their brands, which is good because it makes them stable. That people can't come in and switch products away from General Mills products. But it makes it difficult for them to capture new business. In addition to that, when I look at the 10K, and I'm surprised I haven't gone into this earlier in the videos, but if you look at the executive overview, this is from their 10K, in item 7, the executive overview, their objectives are to consistently deliver low single digit annual growth in sales, mid single digit annual growth in segment operating profits, high single digit annual growth in diluted earnings per share, excluding certain items affecting comparability. Um, so General Mills' management is even saying, hey, we're not looking to grow this business very fast. It's going to be a very slow growth company. And as we showed, net income and free cash flow and all of that are pretty tied to how much in sales they do. And if they're not growing sales at a rapid rate, they're not going to be growing their free cash flow at a very high rate. So I think this justifies a rather low growth rate, and I would even be aggressive and say, let's go with high single digit annual growth in earnings per share. Let's go with a high single digit. Let's do 9% and get aggressive. So this is a best case scenario for General Mills growth. We went aggressive on free cash flow at the starting point. We're going to go aggressive on the growth, even per management, who should have a much more rosy picture about how the company's going. Um, so the last component in our valuation is our discount rate. As we said, in numerous areas, I see this as a very, very stable company. People are buying Cheerios, people are buying Wheaties, people are buying their pastries. It's very stable, and people are very loyal to the foods they buy. I know in our house we buy the same products over and over and over again. So sales are going to be consistent. It's a very low risk company. I could even go down to 6% discount rate on this, like a bond, and say that's reasonable. Given their debt load, though, that gives me pause though, because I don't like debt, and if we do our absolute PE score metric that we've been doing, the business risk is rather high. They could very well lose some business and be cannibalized by other products in the market. It's a very competitive industry. They could get squeezed by a Walmart, who's probably one of their biggest vendor or biggest customers. Now that Walmart's the largest grocer in the world, so their margins could get squeezed. They have very competitive environment. So price is a big factor, which is obviously going to affect their margins. So there is a lot of business risk. There's a lot of financial risk, given their debt load. But their earnings per share, I'm surprised that this is this low, because I think that a company this stable would have much more predictable earnings. So if we add all this up, 27 and 12, what is that? 39 out of 60. That's not very high. And when I said the average of 30 and I take the discount rate, that gets me about 10%. I'm shocked at this. So I'm going to even be more aggressive with them, and I'm going to give them 8% because I think they're just they're just that stable of a company, and they have that strong brand loyalty. So I put all that in, and I've been aggressive on all three of these. Hey, or is that refresh? I get a fair value of $47. That's being very generous with their numbers. We went high end on growth. We went the high end on the low end on the discount rate, and we went on the high end in free cash flow, and we still got $47 based on a 45.33. So it's fairly valued, given very, very aggressive assumptions. It's a fair valued company. Now keep in mind, this price did jump significantly over the last week when Heinz announced they're being acquired by Berkshire, and G3, I believe, is the name of the company that's the partner for Berkshire in buying Heinz. So they jumped up. They were around 40s when I first started looking at this. They were hovering around 40. So that was giving me a margin of safety of a little less than 20%. I think that's very aggressive. I think growth's very aggressive. If we put this down to the 6% range and refresh it, I mean, it's looking like it's overpriced at this 45.33 level. Fair value is saying 37.88. So I think what I'm seeing here is that it looks overvalued in free cash flow. So why don't we go with our owner's earnings and see how that's doing? Owner's earnings. We're going to refresh that. Wow. The spreadsheet's giving me 18.34 as a fair value. So that seems low, given that they're trading at more than double that. So again, we got our discount rate. We're going to do a very aggressive 8%. We'll take our owner's earnings at the aggressive end at 12.72. Over here, you can see that 12.72 on the trailing 12 months. And our growth rate is at 8.4 on owner's earnings. Again, we were in the high single digits is what they were saying everything was going to grow at. So even if we let's go at 10% and say we beat everything, and that's saying we're going to grow 10% every single year. They were achieving some sort of range in the mid digits. So sometimes it's going to be high, it's going to be at the high end of 10, sometimes it's going to be at the low end. We're going very aggressive and saying 10% here. And we put all that in, we get owner's earnings at 32.01. Again, that's rather surprising that they're bid up that high. And I think this is due to a lot of people looking for stability. They're looking for a safe yield. Given the low interest rate environment, people are going out trying to find dividend yield that is very stable. And when you do that, you end up with a company getting their stock price bid up because they are that stable. But given my discounted cash flow analysis and my thoughts on where I think they're going and being very aggressive with it, I see them as being overvalued at this point. I'm not saying it's a bad company. I just think that the price right now is a little too high, given their growth prospects. I think if you're looking for a nice, stable company that's not going anywhere with strong brand loyalty and is going to be around in 30 years, I think it's a great pick for that. I think if you go through the dividend discount models and you see that dividends have been growing at a steady rate, this could be a good dividend stock for you, just to protect your downside. But that's not the way I look at companies. That's not the way I value them. So I may be in the wrong camp on this, but I don't see this being the right time to buy. Now, if this thing drops, I would be in a heartbeat if I could get this at a good price. If I could get this way back when it was cheap, I think I would be in on it. But for right now, I just think now's not the time to get in General Mills. It's a great company. I love their products. I'm a huge fan. I just don't see the growth prospects for them in the future, and management doesn't either. So I'm going to steer clear. Now that may be surprising, given that Buffett paid a premium for Heinz, who has a very similar business model, obviously, similar brand loyalty, and similar growth prospects. They're kind of the same thing. They're kind of the two companies that are on your kitchen table at breakfast, lunch, and dinner. So why would he pay a premium for that? I'm struggling with that, and I've yet to figure it out. I know he got a little different deal. Jay wrote back to me when I was talking to him about it, and gave me the insight on his preferred shares. I hadn't done much research on how that deal was structured, but it seems like he got something else on the side that he found attractive. And Buffett seems to be recently getting a lot of preferred shares out there, which are just kind of high yield dividends, dividend or bonds in that manner. So he's looking for cash flow being thrown off from these nice stable businesses that he doesn't have to worry about the fluctuations in the stock price. All he cares about is the return he's getting on his shares. It's very stable in the cash flow in that regard. But we're not in his boat. We don't get the synergies of that. Buffett also gets the benefit of full control, or at least a partnership that has full control of the company, which gives him tremendous insights that we don't. He seems to be buying companies that have a lot of intelligence in what's going on in the marketplace and in the world. So he has that advantage that he can go in and take a look at these reports that they're seeing on market data and demographics and economic outlooks that the normal investor won't have. So he's getting that sort of value too, and that's kind of an additional intrinsic value that he gets that we won't have. So right now, these are my thoughts. I'm kind of taking a risk here, I guess, by going in the opposite direction of how Buffett valued a similar company. But this is where I got to on this valuation, and I like the company, which I was shocked when I did this that it was that different and it was that far off from where it was, because I did almost buy it in a previous life when I did the analysis a little differently. I almost pulled the trigger on buying them, and then I started to get more involved in this type of analysis, and it came out much different than I expected. So I can't wait to hear your thoughts on this one, because this is a company that's going to be the subject of great debate now that Mr. Buffett has weighed in on the industry. And I look forward to your comments on this. Keep them coming. Thanks to everyone who's made comments. They've really helped me increase my view on the world and increase my perspective on how to value companies. I may not agree all the time with what some of you have mentioned, but your analysis is appreciated. It's really got me thinking, and that's the goal that I wanted to get out of it. So thank you all again. Next week or next time, I'm not sure what company I'm going to do yet. I'm still looking for one. Somebody had mentioned Corning. I don't quite know enough about Corning yet to decide if I want to do that one. General Mills was kind of on my radar already when somebody suggested it. So it might be Corning, it might be something else. If you guys have a thought on one that you want to see, let me know. I'm looking to fill my pipeline here. Thanks for listening, and I'll see you next time. Take care.